Welcome back to another sci-fi episode where psychology and finances intersect, and we'll continue to examine how we think, feel, and behave with money. For today's episode, we're going to be talking about simplifying financial planning. Now, I would love to say 5 simple ingredients for financial planning, but nothing about financial planning is simple. If it were, I would be out of a job. If you can just take these areas that I'll be discussing today and explore them further, that would give you more confidence and hopefully through practice a little more competence as you are planning out your financial journey. I provided a class to an installation. It was a very large class. We had over 1,100 participants. And so I got some really good survey feedback. I'll share that as we go through, but I offered some survey questions throughout. So we got some live statistical data just from that population. And to give you an exact number, there were 1,122 participants. So when I give you percentages, it's an average of all of the surveys that I provided for those 6 different classes that reached 1,122 people. Let me give you the areas of exploration: spend planning, tax planning, debt management, retirement planning, and estate planning. And if you are new to finances, you might be thinking to yourself, oh my goodness, that's overwhelming. No wonder people don't get this right. And it's not about getting it right. It's about continued exploration, continued experimentation, and knowing where to find the information and the tools that you need. I've been doing this for a while, and I still come across new tools and resources that I think to myself, wow, this could have been awesome to know earlier, 10 years earlier. But I don't need to stop and beat myself up over that. I just need to enjoy the moment that, wow, I found a tool that actually works with my personality and I enjoy it more. So hopefully that's something that you gain from this today. Let's talk first about cash flow. If you don't like the word budget like I don't, that's good. Let's stay away from that word. But let's talk about cash flow because that makes the actual spend planning a little more approachable, because all you have to do in a cash flow is get your income, deduct your deductions. So really, if you just have your net pay, but you should take a look at those deductions to make sure if you are putting money into a savings account that you have a ledger that also tracks what you're putting in that savings as well. You don't want to sell yourself short on that area. But cash flow, simply your net pay minus all of your monthly expenses. It shows where you've been. A net worth statement shows where you are. You simply list all of your assets, which are the things that you own, but only the value of the things that you own. And then you list your liabilities, and that is what you owe on the things that you own. So again, you subtract those liabilities from your assets. That lets you know what your net worth is. For some of us, we have a positive net worth, which is where we want to go. It helps you understand if you are building wealth or not. For some folks, it lets them know they're building debt. If you have a positive net worth, you're moving towards building wealth, and that's where you want to be. If you have a negative net worth, take a look at all of those debts and how can you get rid of those? How can you prioritize your spend plan to pay down those debts faster? Now, for some folks, they're going to have a negative net worth because they just purchased a home. Maybe they're younger, they're just starting out, it's their first home purchase. Perhaps they'll have a negative net worth until the value of the home increases and the principal on the home decreases. So we don't want to make anyone feel badly if they have a negative net worth, or to imply that they're doing something wrong if they have a negative net worth. It depends on your developmental stage, but you'll know. As soon as you sit down and you get these numbers, you'll know what's healthy, what's unhealthy. Okay, and then we get into turning. If a cash flow shows where you've been and a net worth shows where you are, then a spend plan shows you where you want to be. And there are multiple methods in how to develop a spend plan. I personally like the zero method, where you give every dollar a job and you neither have a surplus nor a deficit because you have given every single bit of your money a category to follow, even savings, investing, debt repayment, those things. So here's an interesting thing that we found in the actual class. This was a live class with live stats. So I asked the question, do you have a written or recorded budget that you follow? Now, I did have to say the B word so folks knew what I was asking, but truly we're saying spend plan. 60% said no, they do not. And that falls in line with the national statistics that are generally published by different financial experts and what they find with folks. 60% do not have a spend plan. And here's another question that I asked. Do you track your spending on an app or a register? It could be a debit register, a check register, depending on our personality, not just age. We have a different method of how we want to do that. 65% said no. So not only do we have 60% not recording where their money is going, how their money is coming in, and where their money is going, but even 5% more are saying that they're not even tracking as they're spending. That's dangerous. So if there's anything that you can explore here, it's how am I tracking my money? And I like to stalk my money. So every month I sit down, I go over what's coming in, I go over what's coming out, I adjust if I got it wrong last month or I had to incorporate a new section, and I adjust accordingly, and then I put it into my tracking app, and then I track every day. So I am stalking my money every day so that I do not go outside of my boundaries. So that is spend planning. Now, I could do a whole episode just on that, but that is just something for you to further explore. The next exploration topic would be taxes or tax planning and how you can reduce your tax liability. So I asked a question during this segment. Which method is illegal? Tax avoidance, tax evasion, or both? Well, 59% said that both tax avoidance and tax evasion were illegal. But thank goodness 41% got it right and said that tax evasion is the only illegal method. So a lot of folks don't even know that tax avoidance is a good thing. It's encouraged by the IRS because they give us so many methods for reducing our tax liability, whether through our traditional contributions into the thrift savings plan, or for other folks that may not have access to the thrift savings plan, your 401k, any tax deferred contributions. That helps reduce your tax liability. And for some folks, they really need to do that in the current moment. But for some folks listening, Olivia, I don't even know what tax liability means. I don't even know how to reduce it. So what I like to tell folks is when you are planning your finances, whether you are rich or poor, and by the way, I don't even like to use those terms because there are people who don't have a big income but can still manage their money well and have a higher financial well-being score than folks that have higher incomes. So I really don't like to use rich or poor, but just for this discussion, I will, because whether you're rich or poor, you could pay better attention to reducing your tax liability. You could pay better attention to knowing that I don't have to give more to Uncle Sam than is not required. So for example, we have in the federal government, we have the flexible spending accounts for dependent care and health care, a great way to reduce your tax liability, especially if you have small children and you're paying so much money in daycare, or you have special needs children. And even if you don't have special needs children and you pay a good amount of money every year towards medical needs, or you have children that are ready for orthodontic care, or you have rambunctious boys who are always going to the ER and you have copay upon copay. This is a great way to reduce your tax liability. So again, further exploration, finding out. And by the way, a lot of these links will be provided to you in the post below. So just take a look at that when you're done listening. But here's one of the bigger things that a lot of folks don't know, whether you have the flexible spending account opportunity or not. And a lot of non-federal entities also provide this. But one of those things is adjusting your withholdings so that you get more money in your paycheck every month, so that you're not giving Uncle Sam an interest-free loan throughout the year where they just hoard your money that you're giving them and then give a lot of it back to you at the end of the year. Instead, you're saying, you know what, I would like to have that money now so that I can save more, or so that I can pay down more debt, or so that I could meet those financial obligations that are pressing in the moment. Because for some folks, there are folks that get 10,000, 11,000, ridiculous amounts back in tax returns. And if they could have a portion of that added into their monthly income, that would make a huge difference for their financial well-being. So talk to a tax preparer, or even just go to the IRS estimated tax withholding calculator online. That's something that you can look up. It will tell you what documents you need to get the best calculation. But that helps you to figure out what you need to place within your employer's withholding section for your payroll, so that you're not getting a large amount of money at the end of the year, but you're getting more money in your paycheck every month. Now, some folks, and for some folks that may not work, but I will tell you, psychologically speaking, there are folks that would do better having smaller increments coming in every month to be used, I guess, efficiently and productively, whereas a lot of folks who receive a lump sum are going to be more impulsive and be, I guess, they would not use that money in the best way. So if you know that you have a set income every month, you're more likely to do better things with that money and make better decisions. But it really depends on your personality. It depends on where you are financially. There are a lot of pros and cons to each. So it's up to you to explore that further. Let's talk too about some other tax considerations. When should I seek professional guidance? So a lot of folks have filed their taxes on their own for several years, and that's good. It's good to understand how to do that. Maybe make yourself a little more confident in understanding what your deductions are. But when you reach a certain point in life, it is actually recommended by financial experts that you seek out professional tax guidance. So that might be when you have a side hustle or a business, or when you have an income property. And some folks might even say when you own a home. But it really depends on your comfort level, how things are going for you. But there are differences in those tax professionals. You can seek out an enrolled agent. You can seek out a certified public accountant. But did you know that there are also folks that are considered tax preparers who have no official designation or certification? So if you didn't know that, that's worth exploration. Who am I paying and who am I trusting to file my taxes? And depending on your situation, you may only need an enrolled agent, but in other situations, maybe you do need a CPA. So let's move now to the third exploration: debt management. Understanding the cost of debt. There are several calculators that you could just Google and pull up. What will it cost me if I have this balance and I pay the minimum monthly payment at this APR or annual interest rate? it will tell you how long it will take to pay that off, and it's quite sobering. It's a great educational tool, not just for yourself, but it's also a great educational tool for your kids that might be getting credit card offers in the mail. Usually, when they're 18 years or older, they start getting those offers. So that would help them understand. And also, what would happen if I take out a cash advance, understanding that the daily percentage rate starts as soon as you take that out. And it is a daily percentage rate, not an annual percentage rate. So there are things to consider in that regard. So, how do I pull my credit report? Where do I pull my credit report? How do I get a truly free credit report? Well, that's through www.annualcreditreport.com. You will not be asked for your credit card. You will not be asked for a trial. Everything is free. You can pull a free credit report weekly if you'd like. And there are 3 major reporting bureaus. And if you haven't checked your credit report in a while, it would be a good idea to pull each one of those credit reports over a 3-week span to make sure that there's no nefarious activity, and also to dispute any items that are not yours or to dispute information that is incorrect. I've told people I've corrected the spelling of my name. You never know why that may have happened. Hopefully it was just human error and not someone attempting identity theft. So it's a great idea to stay on top of that. And also educating yourself and exploring your children's credit reports. What do you need to know about that? When can I access them? When should I access them? When should I start seeing if everything is okay with them and are they protected? But one of the bigger tools that I like to educate folks on, and one of the best exploration tools for debt management, is POWERPAY debt reduction. And POWERPAY is a free software program. And again, I'm going to be providing the link below. The one that I use, it's very effective, very user-friendly. Please do not feel like you need to pay for a demo or pay for a class. Play around with it, click around, you'll figure it out. But this is a place where you can either use what you have heard in maybe different podcasts or what you've read, where you can use the snowball method, you could use the avalanche method. It doesn't say those terms, but snowball is simply just paying lowest balance first and then taking all those other minimum monthly payments that you've paid off those other debts and rolling them into the next debt payments. The avalanche effect is where you shoot for paying off the highest interest rate first. And so that wipes out a lot of that interest. So you'll save more money in that way. But it will provide for you the total savings for each method. And psychologically speaking, a lot of folks do better with the snowball method because they know that these smaller debts are going faster, and then I can feel good knowing that I've taken that off. But it really depends on your situation. If you have a payday loan, we definitely want to get that paid down first. The interest rates on those, a lot of people don't even understand the interest rates on those. Or if you have a buy now, pay later, those are kind of wonky and almost becoming scam-like, and you can't even get people on the phone, and they're not being responsive. So making sure that you pay those things down faster. And then security clearances, favorable and unfavorable practices. For those that do not have a security clearance, maybe that's not something that you have to explore, but there is a different episode that I have recorded on your money, your defense. If you have a security clearance, go back and listen to that. And then the next phase of exploration within your financial planning journey is saving and investing. Understanding the difference between the two. One is short-term, one is long-term. One is quickly liquidatable, the other isn't. So understanding what your own financial goals are, what you need, when you need it, those are things to explore and understand. And for federal employees, we have the Thrift Savings Plan, and understanding contributions and understanding the matching that you would receive. Where does that go? How much comes in? There are TSP webinars for that. And if you are not a federal employee, whoever employs you, work with your benefits team. It's usually with your human resources team who can shed more light on the different webinars that might be available or classes that might be available on those benefits to you. And a lot of folks say that they're ready to invest beyond their 401k, but if they're not meeting financial obligations, if they're not paying their bills on time, they're not paying credit cards in full every month, or have emergency funds set aside, or they're not covered adequately for insurance, then maybe not. Maybe it's not their season to do that. But when it is your season to do that, and when you're ready, make sure that when you hire a broker or advisor, that you are checking them on FINRA broker check to make sure that they are not barred, to make sure they have no actions against them. And you can also go to FINRA Investment Education and take these free investment courses. I would highly recommend that because it is not advisable that you ever invest in something that you don't understand. If you don't understand market volatility, if you don't understand that markets will rise and fall, if you don't understand your risk tolerance, then this is probably something you need to hold off on until you've educated yourself further. By the way, I did another survey in this class and I asked the audience, how many of you know your risk tolerance? Only 47% understood their risk tolerance or investment philosophy. I tend to be a moderate. My husband's a little more aggressive, but I also have several conservative clients. So it's important to work within that framework. If you're married to someone who's a little more conservative than you are or more aggressive than you are, finding ways where you can both agree to things that are not making one or the other sick, thinking that this is what's going on. So, and then also when you're ready, seeking fiduciary advising. And fiduciary, this is a term you need to understand. And I love how an attorney put it once. She said to think of fiduciary and to remember that as a mnemonic, think of Fido. Fido is a loyal dog. A fiduciary advisor is a loyal advisor. They are only putting your best interests at heart, and they are only seeking out investment vehicles and products that fit your investment philosophy and your risk tolerance, not the firm's. So that's a great thing to further explore. And then here comes the fourth when we talk about retirement planning. I asked in a live survey, when should you start retirement planning? And I gave the options in high school, when you first enter your career job, or when you're 5 years out from retirement. There were folks that selected when you're 5 years out from retirement. But I'm here to tell you that retirement planning really needs to start in high school. And I get it. There are some high schoolers that may not be ready for those conversations, but it starts with career exploration. That's why it starts in high school. Talking to your kids, talking to your grandkids about what are their hopes for the future? What kind of quality of life are they looking for? Do they want to have their vacations in the backyard, or do they want to have them away? And some folks may choose the backyard, and I think that's absolutely enjoyable if that's your thing. But if not, then what will help you live the lifestyle that you're seeking while having the ability to save for your future self? And I guarantee you, your future self will congratulate you and thank you for taking such good care of him or her. So one of the ways to do this is to understand your numbers. And for the federal employees here, we talked about the Government Retirement Benefits Platform, short GRB platform. And again, the link will be provided to you. But understanding your numbers, your retirement service computation date, that's going to be different than your leave service computation date. And a lot of folks don't realize that that is not provided to you until you ask for it within 5 years of eligible retirement. But I'm hoping with more efficient practices that our Army Benefits Center or whoever your federal employer is will be able to provide you that retirement service computation date at any given time. Maybe a system where we get to see all the different service computation dates that are there for us. There's a TSP service computation date, a leave service computation date that is only tied to leave accrual, and then a retirement service computation date that is only tied to creditable service that will apply towards your retirement. And those in the federal government, we know that those years of service are very important when it comes to not only calculation, but also to understand if you're even eligible for certain retirement. Then also understanding your high 3 calculations. And for folks out there that may not have a defined benefit plan like this, that's okay. It's all about retirement planning and understanding what kind of nest egg you would have to have from your defined contribution plan. So what you're doing with your 401k, how you're investing, and how much you need, and getting those numbers, that is part of that retirement planning as well. Understanding your Social Security, setting up an account, making sure that you have all your credits that are due to you, making sure that all the information is correct, understanding what your tax bracket might be in retirement, which will help you today in determining, do I need to do more traditional contributions or Roth contributions? And that will help you decide how to best plan for that retirement. And here's one that I like to give folks. Debt is a big enemy to retirement. And so I would encourage folks that are nearing that retirement age is to really look at your debt and how can you get rid of as much as you can before you retire. And one of the ways to look at this is to project what your retirement income is going to be, deduct your living expenses, and deduct your monthly debt payments, and that will reveal what your surplus or your deficit is in. If you have a deficit, obviously it's not time for you to retire. If you have a surplus, perhaps even now, while you have a larger surplus, how can I pay down that debt even further? And here's an extra challenge. 2 years prior to you retire, live on that retirement budget or retirement spend plan that you've created. And that will help you determine if you're truly ready. So here was a fun live survey that I provided. I asked the question about numbers and data for retirement planning. 96% agreed that retirement planning is not just about the numbers. So no one has an excuse anymore, what I'm about to talk about. So we're going to talk about what you are looking for in retirement. As Mitch Anthony wrote in his book that I do have an episode on with reviewing the book, The New Retirementality, he talks about your IRA or individual retirement attitude. So know your values. Planning includes the measurable data and the immeasurable data. That immeasurable data is, what does your wife want to do upon retirement? What does your husband want to do upon retirement? What are your joint goals? What are your individual goals? You both might be putting your ladders up against completely separate walls, and by the time you both retire, you're looking at each other miles and miles away and like, hey, where are you? You're supposed to be over here with me. No, you're supposed to be over here with me. This is what we plan to do. Did we? Did we even have that discussion? So understanding what that means for you. And then also further educating yourself and exploring all the ins and outs if there is a pension plan. And again, if it's not a defined benefit plan, which is a pension, then understanding all the ins and outs of your defined contribution plan. And then finally, we get to the last phase of exploration. Not to mean that you wait until you think you're going to die to do this, but to start planning now. But estate planning. This is something where I can't emphasize enough that individuals who come into my office, widows, where their spouses have passed on, or widowers, and they don't have any money because they can't find documents, or they don't know what's available, or a designation of beneficiary can't be found. Estate planning, when people hear that, they stop and they don't think about it again because they say, well, I'm not going to pay the attorney to do this for me. You don't have to. Estate planning can be as simple as you just completing designations of beneficiary and filing them with those entities they need to be filed with. So for federal employees, your thrift savings plan, who gets the money when you pass, naming a beneficiary, your federal employee group life insurance, and for folks that aren't federal employees, that includes your 401k, your life insurance, and any other things, your bank accounts payable on death, your investments transferable on death. Just completing those forms alone is estate planning. But here's one even better, is putting those documents or copies of those documents in one area and telling your loved one where they can find them if something were to happen to you. So notice that a will has not even been created yet, and you've already inched toward full estate planning. There will be attorneys that even tell folks that maybe you don't even need a will. It depends on everyone's situation. Disclaimer, everyone's situation is different. Had my husband and I not had children, we probably never would have completed a will because we have everything tied to a beneficiary or a joint account or payable on death or transferable on death. Those are ways to avoid probate court. And 81% of the audience knew that. They knew how to avoid probate court. Again, naming a beneficiary, make it in a joint account, payable on death, transfer on death. However, you can't 100% make sure that some things do not go to probate, because what if your joint account holder passes with you? Or what if your designation of beneficiary, all the folks that were named, have also passed on? So sometimes you cannot help but things go in, but you can at least help avoid as much as possible by doing those three things. Here's something that kind of troubled me a little bit. Well, no, let me actually say what excited me first. 100% of folks knew that it was wise to update their beneficiary designations when they got married, had children, or divorced, or remarried. So you just have to ask yourself a simple question. If I pass, who do I want these benefits to go to? By the way, here's what saddened me. 31% did not know that beneficiary designations override wills. A lot of folks did not know that a beneficiary of a beneficiary designation is its own standalone legal document. So if I've scared some of you guys, good. Go look, make sure they're on file, make sure the right people are on there, and go from there. And even read through the form. It will tell you, if you name no one, who it will go to next. Your spouse, your living children, and then it goes from there. All right. So here are some further tools and resources. I've given you a lot to consider, a lot to explore. But in these episodes, you'll find book reviews. And so any of the books that you've heard, I really recommend reading some of them. But one of my favorites, if you really want to understand personal finance, and I can say that I would encourage a read, because to be an accredited financial counselor, and in order to get that certification, I had to read the book Personal Finance by Garman and Forg, the 13th edition. And I would not be able to sit here and provide this education as a financial readiness program manager without that book. It's called, now the 14th edition is out. I have not read through that one, but I would always encourage people to read latest editions, because especially as technology advances, there's going to be some changes in how you do personal finance. So Garman and Fox are the authors, 14th edition for personal finance. And like I said, it's a textbook. It's not going to be something that you're going to be reading right before bed, unless you just want to put yourself to sleep. But what I would encourage you to do, maybe a chapter a month. And getting your spouse involved, because this is full exploration that this book would take you through, with all, not just those 5 areas of exploration, but 15 areas of exploration. And maybe you just start with the 5 that I've talked about today and then go back and get all the other ones. But I would also encourage you to listen to other episodes on the pod that might be of interest to you. And please, if you have found this information useful, please rate and review wherever you listen to the pod. Thank you for listening, and happy planning.